Mr. Chris Frostad. How are you, sir?
Pretty good, Matt. How are you today?
Hi. I'm well. I'm well, but you've come back from a little break, all suntanned
I did have a
and
break. You can't
gorgeous.
really, yeah. It's
Yeah,
But a week ago you could see me from space. So I mean, this is doing pretty good.
that's
But,
a nice
yeah,
off-white color you've achieved.
yeah.
You know,
Thank you.
think that's different. I've had to lower my lighting just to achieve a similar sort of tan level to you because I don't want to
There you go.
set people. Yeah. Right. We are today. We are going to. Do you know? I think it's a fantastic time at the moment because the markets have been so freaking difficult for companies that the CEOs and the boards are having to think really hard about how they stay relevant, how they make themselves attractive in lots of different ways. And we've seen lots of sort of hybrid business models being formed, which I'm loving. But and we're going to talk about those another time as well, because I think yours is one of your favorite type models as well. We're going to talk today about all the things, the other variables that retail investors fail to take into account whenever they're trying to value a company, things that can make or break the companies. So I've got a big long list things like
No.
things like jurisdiction and management teams and partners and the kind of the technical aspects around drilling or interpretation, etc. So I'm going to whiz through as many of those as I think we can both stomach without shouting over the top of each other, and maybe it gives some people clues as to some of the things that other than grade that they should be looking at, because that's my sort of my little bugbear. People talk about high grade projects. That's all you should worry about. Off we go. And I think we've got enough examples now where that's clearly not true. So, should we start with jurisdiction?
Sure.
Yeah.
Jurisdiction, always good. Always
Always
good.
good. So basically, we've got to think slightly outside of the world of uranium today. We'll drag in a few other metals as well, but uranium is our thing. So in terms of how do you balance country level risk with regional mining culture?
Whoa.
How's that for a
Well,
nuance?
it's, and I'll mention. I was reading. It was in the Northern Miner. John Capaglia from Sprott was talking about the S&P Global survey that had come out, and they'd found that Canada was the third worst, slowest globally permitting jurisdiction in the world at 27 years apparently. Now that's not uranium specific, but it was only third behind Namibia at 34 years and the U.S. at 29. So, you look at Canada, you look at the U.S. jurisdictions that you think are typically prosperous and good jurisdictions to be working in. There's things that internally here that slow things down significantly. I know the politicians, we're undergoing an election today, as a matter of fact, and all of the candidates are talking about streamlining the whole permitting process. But when you look at NextGen, and they've been getting pushed. I mean, they've been, I think, 7 years into their permitting, and these are permits that have already been approved provincially. They've been, they're getting along well with the communities. They have their agreements in place, and yet they're still waiting on federal permitting. So jurisdiction covers a lot of things, but as it goes with permitting, it's if you're looking to take something into a mine, it's not a small component.
Well, I think because I think it's important. One of the important things for me to look at is, and I was talking to Jim Peterson over at Valor earlier today, and we're going to kind of look at Brazil, right? So, but Brazil's a big country, and there's lots of space, and the same down in Mexico. Lots of different places where are better to work than others, and that's why I think looking at a country, or as I think some people like to do, look at a continent like Africa and say that's all the same, is nuts, because state by state, and even Canada, province by province, some places are easier to do business than others. Some are mining friendlier than others. And I think it's nuance when it comes to investing. So there's money to be made by understanding that one point.
Right, and even if they are mining friendly, I mean, Canada is very mining friendly, as is Mexico. I liked working in Mexico because the rules were different, but they had rules. So when you understand what the rules of engagement are, it makes it very easy to to operate in that jurisdiction. But that also means, on the other hand, that they're keeping a closer eye on everything that is going on, and things such as the environment, such as permitting, such as all the environmental work that needs to be done, et cetera, is going to take time, and it can slow things down, which is the other side of that argument. And again, even jurisdictionally, as you said, I mean, Saskatchewan's one thing, Quebec, and I was always confused. I thought they had a moratorium against uranium mining, which kind of took Stratico had a operation out there, and actually ISO owns it now. It wasn't so much a moratorium as it was the government at the time just didn't want it, and they couldn't get anything permitted. So even where permits are allowed, and even where it is allowed, sometimes the government of the day is going to slow you down. There's a big uranium mine in Virginia that can't get off the ground because it's not allowed in that particular state. So yeah, there's some granularity to a lot of this stuff that one needs to take into consideration.
Well, absolutely. I look at Mexico and the silver miners. There are definitely states there which are a little bit active at the moment, shall we say, when it comes to the different drug runners. What are they called?
Well, it can be
cartels, right?
Sure.
Cartels,
I mean, when we worked down there, we had most of all of our technical staff were Mexican domiciled. I mean, they were Mexicans, and I mean, I can show you places in Toronto you shouldn't be walking at night, and it was the same kind of thing there. There's places that are fine, and there's other places that aren't, and they knew what wasn't, and how to go about it. And so, they know how to deal with the military there because they're there for our protection, or how to deal with the police who aren't always there for our protection. They're there for a few bucks, or where areas were particularly dangerous from one day to the next. We'd been waved off, for a few weeks because there's some aggression going on between a couple of drug sanctions, if you will, and we just shouldn't be there for now. But a month later, they know, yeah, we're okay. It's fine. So it's, yeah.
You need to know how to operate. I think some pretty dodgy places in Toronto during the day as well, like King Street, Bay Street. Some of the brokers are criminals. Right. So, yeah. Okay. Well, it's interesting. So those are these, and we're going to kind of lightly touch upon a lot of different points today. But the point is, if you're aware of what those points are, you can ask questions about them, and maybe try and sort of understand how your investment, the company you're invested in, grades against that. So the other kind of big topic, sticking with jurisdiction for a while, of the last few years with ESG, the rise of ESG has been around sort of indigenous land rights and social license to play. But those things have always been true. It's just now that the fund's kind of jumped on the marketing bandwagon over the last few years. So can you maybe your views on how it used to be and how it is now? Has it got easier, or have companies got better at dealing with it?
Well, I you know what? It's always been ingrained in the industry. I mean, that hasn't changed. If you're going to try and build a mine, if you're working within a certain community, that's just part of the equation. There's going to be costs involved. You have to work with them. You have to understand their issues and how to make good and be good neighbors. And that's always been an issue in mining. Like safety is an issue in mining, right? It's fascinating working inside the mining industry and to see how they take safety very different than you would around the office. I mean, what are we going to do? Drop a computer on our foot? Whereas, in this case, you're out in the middle of nowhere and people die. So it's like top of mind in a very different way. So the indigenous aspect and the community involvement is something that is as normal, should be as normal within the industry as hiring a cook or bringing in a drilling company, or it's another box that is just part of the business. And I think maybe and so whenever there's an issue, whenever things aren't being dealt with appropriately, then yeah, you start reading about it in the news, and people see things, and roads get blocked, and things might happen. But I think more than anyway, we've always found it interesting that a lot of the exploration companies, et cetera, have to make a big deal about their community involvement as though it's unique. when it, as a matter of fact, well, don't you wash your hands? Don't you brush your teeth? I mean, what are you doing? So it's that we've always found a little interesting, that if you're that desperate for news, you just start putting out that kind of stuff. But having said that, in Saskatchewan, it has been interesting in that things have been changing. It's been changing because there is an ebb and flow to the activity that goes on. And I would say 20 years ago when we were out there, most of the northern communities had not seen the likes of us for 15, 20 years. Ourselves and 500 apparently other newly minted uranium companies went traipsing on into their backyards, and we're not good neighbors. And and there was a lot of issues coming and going back at that point in time. Since then, since we all left, and we're now coming back again, we're finding that the communities and the First Nations in the area are a lot more prepared. They're banding together, if you will. You have a number of communities operating as one, because they know that we're operating all over the province, and they're just more collectively organized. And I think at the end of the day, it's a good thing. It makes for a better relationship. You're not trying to talk to 20 different communities that have never had to deal with the likes of us before. Now you're dealing with a more organized, and you can reach agreements much more effectively.
Well, I think that sort of social banding together is great, because you carry a big stick, and the opposition tends to pay attention when you're carrying a big stick. So I think well done out them. I also think the sort of smaller companies have got better at dealing with it, because it's a much bigger problem for them if they don't than perhaps it was in the past.
Mm-hmm, for sure.
That's what it feels like. I mean, so in talking of which, and there's a topic I know it's dear to your heart, which is resource nationalism, sort of impacting, the geopolitics and narrative of the moment, but it also impacts the valuation of juniors at the moment. So, I mean, how do you kind of factor that into your thinking?
How does the geopolitics factor into it?
Did you say jihad? No, I said resource nationalism trends.
Resource nationalism trends.
Resource nationalism trends, I think, is affecting the markets somewhat. What you look at your lovely neighbors next door. Their critical mineral lists have never been more important to them, and their behavior has never been more extreme.
Yeah. No, and I think in Canada, again, what we're finding, what this has done, I mean, what's going on in the U.S. has been a good kick in the pants to Canada, because it's made us look internally as well. And we have been, quite frankly, relying too much on the nearness of the border for how we operate and trade back and forth, and not with each other. Canada has a lot of trade barriers between the various provinces that make it very difficult to deal with each other. And they tend to be just old things that have evolved over time, but they do become very difficult in terms of how we trade. We can't get BC wine here in Ontario because it's not allowed to cross the border this way. As it goes with resources, we've got pipeline.
Is the wine any good?
I'm not going to. Let's say it is. I wouldn't know. We can't get our hands on it.
Not a loss. Okay.
But there's a lot of things such as that. And when it comes to resources, it's very similar. Alberta and Saskatchewan both have got amazing resources right across the board, from oil to gold to diamonds and potash and all kinds of stuff. And there is a lot of issues around, because Canada is so wide. We're not trading amongst ourselves as much as we should be. The uranium is pretty much limited to Saskatchewan at the moment, so that it doesn't affect us directly. I guess we're going to that. Other than the fact that from all the other external geopolitical things we talk about, the U.S. in particular does require a lot of our uranium, and they've been selling a lot more. There's been a lot more uranium sold out of Saskatchewan in the last year. The numbers just came out, and I don't have them at the top of my head, but it's an amazing amount of uranium got sold in 2024, and it was more about the price that it was being sold at than it was the volume. But the volume is going up as well. So I think uranium is somewhat shielded from a lot of the politics of the day that are going on. emanating out of the U.S.
Yeah, I mean, but it's also happening elsewhere. We need to be cognizant of that too. I think if you look in Africa, we're sticking with uranium, Niger, that is definitely resource nationalism there. Mali, we've seen the same thing, and you can bounce across most of West Africa on that thought. And some of it is benign, i.e., we need better terms with the companies, and they got to pay their fair their fair price for taxation, etc., and not let them get away with so much. And I'm all for that. Have been forever. I've worked in Africa for decades now.
But throughout Africa, it seems to be there's going to be an east-west divide as well as it breaks down. I think Namibia is now looking to put in their first reactor, which means whoever builds that is probably going to have a leg up on. I mean, they're one of the top 5, if not the top 3 producers of uranium. So,
I put out a note out about that today. I think that's fantastic news. I mean, South Africa used to have 2 reactors too, but they don't seem to be getting their act together. But there's of 52 countries in Africa, you've probably got somewhere in the teens the amount of countries which have renegotiated their mining terms with companies, and fantastic. They should do. They absolutely should do that. We should not be riding roughshod. So, here's an interesting question for you in that context, right? So, would you, as an investor, right, would you rather see an explorer in a tier 1 jurisdiction with moderate geology, or in a tier 2 jurisdiction, I say not quite as safe for lots of reasons, but with an outstanding geology? How brave are you feeling?
I think what you're trading off is time to the end game versus the odds of a surprise taking you right out. Is
a negative surprise.
A negative surprise, yeah. Okay. I mean, yeah. I think I would rather have my money where I know I can see the pipeline, I can see where the end game is, and I can get angry about the amount of time it's taking to get there for a variety of things, but people have kind of somewhat control over that. Rather, there's too many jurisdictions right now where you wake up in the morning and there's just bad news that has pretty much wiped you out for God knows how long. So I think jurisdiction's a big
makes it easier.
Yeah,
makes it easier for sure for lots of reasons which we won't delve into now. But it's access to money is easier for sure, skilled labor for sure. And I say no surprises, no coups or whatever life throws at you. Okay, so ripping into the next subject, and I've just come off the back of an interview, I think it's out today actually, with Alex Black of Rio 2, Shane Williams over at West Red Lake Gold. Now, those guys have the benefit of not only are they building their own projects now, but they've been involved in multiple builds before. So, they feel very comfortable saying, we've been there, done it, and got the T-shirt. So we're going to comment on this one. But the big thing that came out of that, when I said, well, what makes this, what's going to guarantee a success? I say, obviously, no guarantees, but the big thing they look to is a track record of the team. So for you, what's more important? Discovery experience, deposit development experience? What do you go for?
Well, if you're in exploration, it's going to be experience, and it's not necessarily how many deposits you've discovered, because let's face it, you could take 5 projects out there, and only the big guy up above knows where he happened to plant some uranium, but it's who's got the experience in terms of what they're looking at from an exploration standpoint. Certainly there's been enough companies out there where someone has found a deposit, it's gone into a resource and been advanced. But, what we've seen over time is that wherever the basin's a big place. It's the width of the province of Saskatchewan, and it's not all homogeneous. It's not all the same. And if you're down near Key Lake, it looks different than you're up near MacArthur, than if you're up in the north in Williston, then you're over on the other side of the province somewhere else. It all kind of looks different. There's a similarity to it all, and there is an underlying geological model you're looking towards, but it does change dramatically. And so I think, when you've got, it's been hard to find, but when you've got people and geologists and people on the ground who have the experience of time and have looked at enough of this stuff, seen enough of the rocks, seen enough of the different um, angles on this stuff, then that's going to be of huge value, because there's a number of companies out there, and you can spot them where they're every once in a while they're coming up with mineralization. They're coming up with something that looks good. That doesn't turn into anything, but they found something, right? That they were, they obviously were on the track of something that needed to be found, and in this, in most cases, moved on from. And that's the only way you're going to find the real one at the end of the day. So when you look at companies, I don't even mind naming them. You've got, you've got Canalaska, who's got people that have been out there for a decade or more. You've got ourselves that have got people that have been out there for a decade or more. Sky Harbor is another one who has, seen a lot of different rock right across the basin, and we know their people, know them well. Many of them worked for us over time, and that they know what they're looking at when it comes out of the ground. The guys at CASA, that's the team that found their hurricane deposit. So I don't think it's unimportant to find people that have got experience in the region, in the area, in logging a lot of core and looking at a lot of different stuff, because otherwise you're going to miss something. You're not going to recognize when you're getting there.
Those are good points, actually. And I think one of the other things I consider is, how much weighting you put on because we're talking about explorers here. This is the discussion we're having is around explorers predominantly, right? Is therefore, given what you just said in terms of experience, like how much weighting do you put on the geologists versus the CEO or CFO? Because explorers are in a very difficult position. You can't afford to take on all the skill sets that you need, because you haven't got the money to do it, and people expect you to be drilling. Quite frankly, is there anything that seems to get valued? But the reality is, geologists are limited in some ways, CEOs are limited in other ways, and CFOs, so what do you look for?
Well, that's been an issue that we've talked about before as well, is when you look at, especially at all these small junior exploration companies, is that most of them are being run by geologists, and Lord knows nobody meant that to happen. And that's not what they necessarily wanted to do with their lives. But that's where it wound up. And I think there does have to be some way of providing both. We've seen some groups, and you mentioned Jim Pattison the other day, that belongs to a group of variety of companies that have been put together. We did this in the back in the technology days as an incubator. We, for the most part, had a complete software development company. It was loaned out to 5 or 6 different companies. So it was the same CFO for 5 companies. It was the same VP of architecture. It was the same marketing, what have you. But you need access to a lot of different skill sets, and not junior skill sets, while you're still a company that can't afford all of that. So I think you have to keep an eye on how they're balancing that, because you definitely need on the exploration side, you need the technical experience and capabilities in the ground, but you also need to run the company, and it's a public company, which makes it even more complicated. So I think you're also looking to make sure that they've got all of those things, both of those things covered somehow, without of course blowing the bank up, because that becomes your other issue. Because if you're not in the field looking at rock, you're overhead. And that's probably another point on your list is how do these companies do everything they're supposed to be doing and operating as a public company without spending themselves into oblivion?
Yeah, Jim's an interesting one, because he's a smart guy. So he's kind of part of a group who have advanced companies, sold companies that got into production. They've kind of been through the cycle. But like Jim's, over there. Valor, and I was lucky enough to speak to him earlier today, and just chat, not interview. And he's been sort of banging the kind of PGM drum for some time. So he's an experienced guy from an experienced team, smart people, great people as well, honest people. But PGM's just not, flavor of the month. People don't understand it. It's a bit esoteric, a little bit too colorful for people, and they don't want to have to do too much work to find out. But they look like they are starting to bring a little bit of gold into the story. And I just wonder if over the next few weeks and months we don't sort of see a very different story there. So you've kind of got the CEO has made the decision, whilst they've been having great success with the geologists in terms of they got some nice numbers around the PGMs, but the market doesn't care. So at some point, someone's going to make a big decision to change. And I say, I keep coming back. I've seen the fantastic changes in profiles and business models and strategies and direction from companies that are going. And I don't mean the guys are going to flip flop. Like, oh, one day we're a lithium company, the next day we're nickel, and the day after we're something else. Where they don't actually know what the hell they're doing. It's where because they have crappy projects. This is an example where the PGM project is actually pretty darn good. The market doesn't care. So they're going to find a way to sort of be relevant again. And I kind of like that braveness.
Well, yeah, and it does take.
You know what I mean?
It's hard to do without looking like an ambulance chaser, right? Because you just keep changing faces every day. And the challenge too is, if it were a private company, not a public company, you'd put it away for a little bit. And you can't. That's the problem we have on the public side is you can't just put it away. I can't just put it on the shelf. I mean, for the most part, you see a lot of them where the market doesn't like it anymore for now. They've got good assets. They know that the cycle's going to come back. It'd be really nice just to hang that project up for 2-3 years and go do something else. You can't. The market doesn't let you do that because you've got a whole bunch of investors who invested in that thing you're about to put on the shelf, and you're about to change change the color of your jacket.
Yeah, and sometimes you get a bit lucky. Like I'm sticking with Jim. I'm not
Well,
picking.
he was a uranium guy for the longest time, right?
Well, that's my point, right? Because they had the asset, which just no one up in Nunavut, no one was paying attention. No one valued. It was like 40 million odd pounds, I think it's 48 million pounds or something like that. Big goddamn project. People get Nunavut, they'll never have it. Flipped it out, I think last year or maybe the end of the year before into Latitude.
Mm-hmm.
And I don't necessarily think that was the right move. I said that to Jim and his team. But it's been picked up by ATHA, the right team, and they're moving that thing forward. And that's a huge project. Could that go from like say best part of 50 million pounds to 100 million pounds or more? I don't. That's what they're trying to do there. But right team, right place. But you've got to know.
You do need the right people at the helm as well to recognize what they're doing that aren't married to the rock, because inevitably, if an exploration team finds something, inevitably they never stop looking for it. They just want to make it bigger and bigger and bigger till forever. Whereas if you have a mining team looking at this thing, they don't care how much you got. I can do a PEA on that thing tomorrow. Let's start figuring out how to get it out of the ground. And that's the balancing act. And if you start doing one too early or the other too late, you're going at it wrong. You're not dealing with it like the business that it needs to be.
Good man. Bringing it back on track. We're talking about track record of team, and I think that applies to access to capital markets is as important as technical success. I mean, if you don't have the money to move the projects on, you're in trouble. And how many times have we seen good projects get capital constrained or stranded all the time? And that's why I think companies like yourself kind of move to the models that you've got, where you kind of partner with these kind of bigger Cameco's and Uranos, Oranos of this world. It just helps, right?
Well, it definitely does. So it makes it a little clear to investors. It certainly makes it clear to us what all of our roles are in this and how we go at it. And, so we are definitely, in the exploration game, but we have a number of projects. We're not reliant on one. Now, again, if uranium goes out of favor again, then we're hooped again, because we are, we're dealing in one flavor in that respect. But that doesn't worry us at the moment. So for us, it's about having enough projects to keep us busy. And the other thing is getting the capital we need. And as long as we've got good projects, then we've got good partners that are going to be able to have the bankroll to help keep that going.
Okay, so here's one for you. You don't necessarily need to name names, but it'd be great if you did. Are there kind of red flag resumes? Because when I get like I'm an ex-banker, I've sat on it from that side, and I'm an investor, and we put big chunks of money in some companies. I got to know who I'm working with, right? And there's definitely groups, certainly in North America, that I'm aware of, and Australia, that we're aware of. It was like, you couldn't give me the money to invest in those companies because I know what the people are. I know the business model. We had it recently with our Chilean copper project. I financed that completely out of my pocket. We got some offers in to take it, basically consolidate the land package, look at the start data, do some drilling, pay a bunch of people off, like not big, like $2.5 million, nothing really. But we got bids from various groups. Like I think I had a bid at $20 million for what we had. And it's from a group, and it's one of those groups I just described to you. It's like there's not a chance in hell. And this was like a fixed bid. Like it was like binding offer. We didn't take it. We did not take it because I'm like, I know how you play this game. I don't like that because I and everyone else is going to get screwed slightly further down the line while you suck money out of the company. So for you, what are the kind of red flags that you look at?
Well, then I look at as an investor or as
Well, I'm talking about in terms of
sitting
the
fund.
specifically with regards to the track record or
Yeah,
credibility of the
yeah.
team.
I mean, it's hard to spot those groups that you describe because there's a number of them out there, and they're professionals at what they do. Because this is because in resources you're talking about such long lead time on anything, right? You're not going to make a buck overnight necessarily. To go find something and then take it right through to a mine takes a lot more time than anybody wants to sit around waiting for a payday. So in the meantime, there's a lot of people and groups that have gotten together figuring out how to make money over and over and over again in the interim. And if they're doing it in ways that are taking it out of other people's pockets, then they're going to be hard to find and identify unless you have experienced them or know something.
I don't want to disagree with you because that's what we do, isn't it, on these shows? I'm going to disagree with the part of what you're saying there because I think they're easy to spot. If people read the press releases, get in and read the quarterlies, and get in and look at the management accounts, you can see who's charging what for what. And there's groups that do we will set ourselves up so we get paid salaries and fees and all sorts of options and free shares. We're also going to charge you for office space, accountancy, legal, and any other kind of consultancy that they feel like charging you. And by the time they've done that, they've sucked off all the kind of spare cash out of their business. So very little is actually going in the ground. I want to see management teams who've kind of set up. They're not necessarily sitting there paying themselves $1 million a year. They're not flying business in first class over. They're not going to restaurants and buying expensive bottles of wine and everything else that I see all the time when I go to these conferences, and that they're focused on trying to get the best information out of the ground, however, in whatever form that is. And I think that's easy if you could be bothered to do the work and question the companies.
And you can only get it down to a level of detail. You don't know whether there's a $2,000 bottle of wine hidden in that travel expense or not. But
true.
But and I think we had a whole episode on this one. I could tell you that if you just look at the exploration companies, the average spend overall, I think, was about $2 million a year overhead, but that has to cover everything that's not in the ground, and you have to start looking at that, and give or take $1 million. Actually, a lot of them were $1 million a year. Some of them were $3 million a year. But that's where it is. And then look at the categories and how it's being broken up. Because one of the other points we made before was the amount of money spent on IR and how it's spent. And it's not to say that you shouldn't be spending money on communications and investor outreach, et cetera, because you have to. Again, we have to get our story out there. We have to raise money. We have to keep our stock prices at some reasonable sense so that we can bring money in to go on the ground. But, it doesn't need to be, 2/3 of your $2 million overhead. It is going to cost. It costs $6-7 million just to keep a public company public. Right. So that you can't touch that. So where's the rest of it going? And a lot of it gets scattered around and hidden, to your point. What is it? Is it overheads? Is it this? Is that? You're going to see salaries. You're going to see consulting fees that are really salaries. You're going to see rent that's really salaries paid to somebody who happens to let people working out of the back of their house. There's a lot of stuff scattered all over the place. So you are looking at it at a more macro basis. I think the The fallacy can come when you start looking at, well, it should be 10% of what you put in the ground. Well, the problem with it, with an exploration company of our size and of the size of the dozen or two that are in operation right now in Saskatchewan, is that your overhead doesn't dial up and down with the amount of work you do in the field, right? It just doesn't work that way, because if you got one project or two projects or 10 projects, your overhead's probably going to be about the same, and should be. There's not that kind of
Well, okay, that's a really good point you make. Say, and I've spoken to a few companies in the last 2 or 3 weeks who vary between like having one kind of project in the portfolio, so it's 8 projects, and others do have a portfolio approach where they may have 2, 3, 4, 5. There's one recently, and I think it's nuts. They because they've not found a way of financing their 8 different projects. I'm like, I don't know where I'm looking, because you're barely spending any money on any of these, which leads me neatly onto, I think, the next thing I want to talk about, which is pretty much your business model, because I've seen it with another company. There's another company called Ridgeline Minerals who do the same thing as you. They've found some fantastically willing majors to work with. In their case, like South 32 and I think NGM, which is sort of the Barrick and Newmont joint venture, I think. And they've done the same thing as you. They've said, right, you guys, they are being treated as the outsourced exploration team for these big companies. You've done the same thing with Cameco and Uranium. So I guess the question is, how do these joint ventures or earning or strategic investments de-risk early stage exploration stories?
How do they de-risk them? Well, in a number of ways. Each one of our joint ventures we've come at for various reasons. It wasn't like we woke up on day one and said, let's do this. We saw an opportunity to partner with Cameco and Uranium, and we grabbed it like crazy people back in the day. Couldn't even at that time have articulated specifically how we were going to see that play out, but we just knew that they were important relationships to have. The one with the transaction we closed with ISO Energy, where we've now have a joint venture with them, 50-50 on a number of projects. That was one that was more crafted in the vein of how we saw this business model moving out. But what it does do is it provides us with constant work and constant payment for that work. It's in any joint venture you look at, there's always a management fee. It doesn't matter whether it's between Rio and Cameco or whomever. Somebody has to actually do the work and or manage the administration of the work, if you will. And there's always a fee attached to that. And that fee is usually, it differs whether you're in exploration or whether you're developing or whether you're in production. If you're in production, they're getting a management fee. So, and the consistent management fee in our deal, not just in our deals. I mean, I haven't seen a joint venture that wasn't of this ilk. It's always 10%. And it's an interesting number because it comes up in a number of places. In Saskatchewan, when we are filing assessment reports for the work we've done, and that's how we pay our rent on these deposits or on these projects, they always allow a 10% management fee. So we're only allowed assessment work on exactly what goes in the ground, plus 10%. And they've actually added 5% more to that recently to cover community relations work and things that are required in that regard. So it's not an oddball number. So in our situation, as long as we remain and are able to do the work to a degree where we can remain operator, it does pretty much cover our overhead. Now, if it was only one of them, it wouldn't. But if we've got 5 of them that are working like that, then yeah, we can pretty much cover our overheads in a given year. Now, that doesn't answer your de-risking. Well, it de-risks us from the sense that we're not necessarily going to run out of money. We've got partners that are sharing the freight, and then on top of that, we're being paid to do the work. And
what it does, I think, why I like these models, is the anti-dilutory nature of them, right?
Right.
The biggest whinge of all retail investors is you're raising money, you're diluting the crap out of me. That's what they hate, unless you're going and finding, the best project in the world with the money that you raise, which it doesn't kind of work like that. It's a bit slower than that. So I think I like that sort of anti-dilutory component. So if I guess the next question for me would be thinking about, again, another constant whine from retail investors, and I love all the whining because these are valid questions and valid concerns. Is um, when you've kind of done these sorts of structures of deals, and the nature of the deals and the earnings is really important. It's like, oh, you're giving away all of the upside in the future, maybe, but you're also keeping the company going and keeping the company alive. And maybe, what's your view in terms of having a small part of something big versus 100% of nothing? How do you view that?
Well, first of all, I look at it as you have to stay in your lane. So we're an exploration company. When you talk about giving away the big upside at the end of the day, is that when this thing goes into production? Because that's not where I monetize. That's not where my upside is. My upside comes at a significant rate when we discover something, when we actually put a resource together, and at that point in time, we've done that with a fraction of the dilution that would have taken otherwise if we held 100% of it. And I'm not sure the market is going to give us a whole less amount of joy for owning 30% of something instead of 100% of it. Discovery is a discovery, and a deposit's a deposit. And if it looks like it's going to be an economic deposit, then you have an asset that the world can start valuing and putting a dollar sign behind. So, and again, we all there isn't an exploration company out there that hasn't got a project that might have a deposit in it. We don't know. You can only maximize the odds of finding it if you have more than one. And so I think like in the case of ISO, we took a handful of projects and put them in, and now it's 50-50 partnership. We think, well, you just gave away half your assets. I know, but I picked up 50% of their assets. So I've increased my odds by double, and I've halved my ownership. I think the upside is actually stronger now than it was before.
Right. Okay. Well, and let's kind of flip to the other side of that, because I'm always intrigued by, you got to be careful of what terminology means here. How do majors versus mid-tiers approach those partnerships with juniors? Because again, I've seen different structures where the majors can afford to be, I think, a little bit more generous, in the sense that if it doesn't kind of meet their criteria, they don't necessarily need to retain 50% of what they do. There's sometimes when I say, well, look, if we don't find what we're looking for, you can have everything back. You can have the...
We actually had that happen
right.
to it.
Okay.
So was
obviously, yeah.
Yeah, this was during the last go round. So we had done a lot of work on our Red Willow project. It was of a size. I mean, that's the other thing. Majors want projects of size too, not just postage stamps. And we had done all of the early work that you could possibly do on this project. We had targets all over the place, and they came in with the opportunity to earn in pretty much to buy the whole thing eventually, if that's where it went. And they spent. It was shortly after we got into it. They had to spend $5 million, say, but they were earning 51% of it in the first go round, and they got about halfway through it and they started to get distracted with the Hathor asset. So we were their first step into uranium back into the basin. They started chasing Hathor, and then they decided to get out of the basin completely, and they pretty much abandoned uranium. Which is another challenge of working with majors, is they can change their mind on a moment's notice because it's immaterial to them. Anyways, it was we had a frank conversation about what do you want to do, and it was, well, we can find you another partner, or we can give it back to you. We took it back. So there was, they'd done as much work as them as an organization were prepared to do on it, and didn't see the upside in sitting on it and stay, and literally parking the project.
Yeah. Because I think for like the mid tiers, they kind of need to create some value at it, because they don't necessarily have a ton of cash to spend themselves. So they'll get abused by their shareholders if they don't walk away with nothing. So, well, that was a waste of time. Whereas the majors are kind of like, well, this is actually cheap exploration for us. You're far more nimble. You get better bang for your buck. When it comes to the drill budget, etc. They're not having to because what's the one I remember in Africa that the company was working with, I think it was Rio or something like that, said, yeah, we're able to do twice as much drilling because Rio have got so tied up in red tape. Like they can't allow people to fly, and they have to fly in like twin prop helicopters in case one.
Believe
Such
me,
a
we
plane
we
goes
had we
down.
had that issue with Rio Tinto.
Oh,
Everything
yeah,
had
the same, right? Like,
they had to drag a whole new camp in because our buildings are too close together.
yeah.
They yeah.
You're like, guys, it's got a bit crazy. But then they're held to, I guess, a ridiculously higher standard. Personally, I do think it's red tape bullshit, but in a lot of cases, but that's just me. When you're having these discussions, I think this is a really interesting bit because people don't maybe look at this type of hybrid model and funding model very much detail. So I think it's worth it in terms of the de-risking thing as well. You can de-risk it by having the partners commit to you know longer work expenditures versus just allocating a budget. So how do you more
Well,
time?
in the case, I mean, ISO is a good example of that.
Yeah,
And again, we're working with these different, and they're more of a mid-tier, but this is how the objectives change or what have you. They're more and more focused and want to be seen as, rightly so, as a developer, and they've got significant assets that they're in the process of developing, and they so they don't get the same market value for their exploration assets. So that was part of it. And resources are scarce, so it was tying up a lot of their resources to be working on all the projects that they did have, and so that piece of it worked for them as well.
you having flashbacks?
I'm having a blackout here. I had a very good point I was going to make.
Was Mexico fun?
Tag this, cut it out.
Nah. Believe me, this in. Want to see slow mental decline of a mining CEO? It's a whole new series.
But I was going somewhere with this. Very important.
Well, I talk about like work expenditures versus just funding, and the sort of deals you structure with people like ISO, who are desperate to be not desperate. They are keen to be seen as a developer rather than explorer, and you kind of, I guess, fill that gap for them.
Right, but I think so. The projects get a different type of exposure to the market, so they're getting different value in that regard. They're able to, it's costing them half as much as it did before to explore the same areas, and they're also, now that we've put them all together, they're also getting to access to increase the odds again, like I was saying, of finding something, because we've put a lot of different projects together. That have far more significance collectively than they did piecemeal as they did before. So all the pieces are there for a win-win, I guess, is kind of where I was going there.
Yeah, I think that's a good point. These partnerships, they truly are partnerships. It's not sort of like one side taking advantage of the other or one side being more desperate.
And that's hard. That's hard to find that right balance, because it's typically there's somebody's looking for somebody crippled in a corner, and this is the guy I'm going to kick, and you don't get. I don't think that's where the really really good intelligent deals come from. When it makes sense for both parties, you one and one can equal three. It doesn't have to be somebody walks away with half and the other one walks away with 1.5.
Do you think we're still at that stage though? Because I've thrown this one at CEOs a lot of time. They go, "Oh, we've got to deal with Rio. We're sorted for life." And I just go, "Well, you and 30 other people, and Rio will work out depending on what they find. What they pay attention to. Not Rio. You fill in any other kind of major, right?"
They're a good one to pick on, though. Yeah,
they're a good one to pick on, right? But they're like the barracks, BHPs, all the same. They got a ton of other stuff going on, and depending on, because actually think about it. If you look at Orano and Cameco with you guys, you had deals with them, and I'd say 2 years ago, 3 years ago, even like half a year ago, they weren't really that busy, right? They had other stuff they needed to convert. And now all of a sudden it's urgent. So they work at their own time frame. So that's the other thing that you need to be, I guess.
We're another variable when they're trying to manage the amount. And this is with majors, right? When times are hot, all the money goes into exploration, and when times are bad, it's the first thing they shut off is exploration. we've kind of given them an extra lever to play with to make sure that, things that are important to them, we're able to move forward on let's face it, on a fairly light budget, because they only have to pick up a third, and they're doing more than just enough to hold it. I mean, that's the other problem with when your exploration budget gets dialed down, then you're just doing enough work to hang on to it. You're not actually doing enough work to find something. But in our case, that's been a benefit to everybody, is that, collectively, we've been able to put together, proper significant programs and get out there and learn something, without blowing anybody's budget, and allowing them to do other things as well. But yes, their exploration teams have been dialed up and dialed down over time, and we've kind of allowed, we've been able to act, to fill some of those gaps and keep a lot of things going.
Right. I think what we're going to do is run this as a sort of trilogy, maybe even a 4-part thing, because we've covered today in 50 minutes jurisdiction, track record, and partners, and deal structures, I guess. Still to be discussed, folks, is basically the how you time coming into company in terms of where it is in its work process. We could look at costs, capital structures, terminology stuff, things like difference between sort of, I know we've done this when we're talking about press races, drill ready versus drill worthy, trying to interpret the language of this sector. We can talk about land. Land's really important. People don't, from staking all the way through, you need to manage that. Discovery stories versus M&A, I think we need to talk about. We need to talk about how do you, I was talking look at the kind of corporate structure as well. I think it's so important. People kind of forget to look at that when a kind of company starting out. Is it set up for success or failure based on how they set up? I think that's a really, really good one. Spend, how the money's being spent, what it's being spent on. Basically, with explorers, like, what is that pathway through to a resource estimate look like? What are the variables that we need to hit and get right and get lucky with? Access to markets, I think, is, we sort of briefly touched upon today, but I think we'll do that a little bit more detail. And clear exit strategy you referenced there today. So we're not in the game of getting into build, we're in the game of making discoveries. So again, let's look at what that leverage looks like for investors specifically. And I think always a little bit of macro here on maybe where you think we are with this cycle. I had the pleasure of having Brandon Monroe stay with me for the weekend, and we talked about that a lot. Because there's a little bit of the audience is slightly, well, I guess, disappointed with the disconnect between equities and what's going on in the rest of the market for uranium, spot versus term contracts as usual, the eternal conversations. I think there's a lot more we can discuss, and maybe we'll run this as its own little series. So shall we call it a day today?
Sure. No, that's good. That's a lot of miles there.
Yeah. And this is all around how do retail investors, what should retail investors look at to value an investment into? We're going to talk a little bit specifically about uranium here, but it can equally, and most of it equally, fit into all kinds of metals here, because the template is the same. The template is absolutely the same. So
good.
Welcome back.
Thank you. Good to be back.
Yeah. Good to hear your dulcet tones.
Yeah, stay tuned, folks.
Stay tuned.
Okay.
Okay, cheers, bye.
Have a good one.